Good morning, everyone. My name is Francois du Toit. For those of you that don't know me, I own a business called Propulsion, but I also built a tool that we aptly now named Taxspace. Originally, it was named the Tax Tool because that's how creative I am. It did have a T3, so if you took the three T's, I did try and call it and make the logo like T3. It was a little terminatory, but I thought also that wasn't good. So yes, we then renamed it to Taxspace. And we are excited to then eventually have taken it from an Excel-based tool onto a proper web app, an application that runs in your browser on any device, basically. This is a fantastic tool. I'll tell you a little bit more about this, but what I want to do is introduce Rudolph Geldenhuys. For those of you who don't know Rudolph has been around. It looks like he started yesterday in the profession, but he's been around for 10 years. He's had a fantastic career so far, and he's really pushing the boundaries in a lot of things that he's doing. Rudolph, you were named for the Financial Planning Institute's Financial Planner of the Year for 2024-2025. And congratulations again on that. I think it's very well deserved. Rudolph is also an apt user of Taxspace, and he uses it a lot. So I asked him, Rudolph, please, will you come and share how you use it, how you think about it, what happens, how do you engage with clients around this, and all sorts of weird and wonderful things that he's going to share with you this morning. So Rudolph, with all those words and a very warm welcome to you, I'm going to hand over to you.
Thanks, Francois. It's wonderful to be here, and thanks for everybody who's joining our webinar today. So I've really started using Taxspace very frequently. It's just built into the process. And why do we need it? Well, as we know, nobody likes paying tax, and it's for a lot of us a grudge payment, but it's part of our day-to-day. So instead of just fighting against it and grumbling about it, let's figure out ways to empower our clients to essentially reduce their tax paying or their tax payments on a regular basis. So there's a couple of things that I'll show you practically using the app, but where it fits into my process when working with clients is especially for non-salaried employees. So this tool is amazing for business owners. This tool is amazing for people stepping into retirement or preparing for retirement, or it's amazing for people with multiple income streams. Because practically, if you think about it, if you're a salaried employee, there's very little you can do about your tax payable, right? Payee gets deducted from your income, and that's pretty much it. But there is a space for salaried employees to use this tool to demonstrate the impact of retirement savings and the positive tax benefit that has on your income. And then you can build those tax savings into your cash flow model. So Taxspace can be used as a standalone tool, but it's probably best used in your own process. So if you do cash flow modeling with clients, Taxspace is an incredible add-on to give you practical insights into someone's tax position and ultimately then use that to better their financial position. So without further ado, I'm going to share my screen with you, and then I will show you just the workaround if you haven't been on Taxspace in a while, or you aren't a Taxspace user at the moment and you are thinking about investing in Taxspace. And then I will also show you a case study, and we will work through a practical element that you can use with clients when using Taxspace. So without further ado, here we go. Okay, so this is pretty much the work of Taxspace. So if you jump onto the tool, it's very simple to use and to navigate. It's literally, as you come in, the most important thing is, here's your list of clients. It's super easy to create a client. It's simply entering name, surname, and date of birth. Date of birth is helpful because that will determine your tax rates. So somebody over 65 will obviously get that additional rebate. So really valuable and important that you input that. But once you've created a client, then you can have your tax scenarios. There's also other things within the Taxspace tool that you can over time also play around with. If you look at the different calculators available to us, there's obviously the tax scenario that we're going to chat about. There's other things that is already live and a lot of things in the development pipeline that we will be rolling out as time goes on. But let me go to the case study, and then I'll show you how I practically built it. Because what does this tool do essentially? Because if it only tells you how much tax you're going to pay, I mean, cool, that's great. But that doesn't do anything. That is like an autopsy that we perform. The person's already dead. What's the point? But in this scenario, what I love about the tool is that you can do and create multiple scenarios. So in the example I'm going to show you today is the current scenario. So this is the starting point with a client. When you meet with them and you've taken them through your process and you realize you can optimize their tax position, then you would say, okay, let's input all your current information. This is your reality. You will be paying SARS X amount. But how do we work in a smarter way? How do we give you a more tax efficient income? How do we put you in a better financial position while limiting your tax payable? Because that's the holy grail, right? If you speak with a client and say, listen, I can give you a more sustainable income, an income that is more than you earn now, and you reduce your tax in the process, I mean, no client would go, Rudolph, no thanks, man. I really like paying tax. So we're going to demonstrate that. So the scenario I created was pretty much, and we'll share these slides with you. This is just the screenshot again, how you navigate if you forget and where you can click. But this is your landing page. If you create a tax scenario, these are the kind of drop downs you have. So if you look at the left hand side where it says personal tax, and let me add my little pen over here. So this is your personal tax side. And then as you click through these buttons, it actually takes you to the different areas, and it actually then opens up these drop downs. So from a tax perspective, you know that you would be loading your client's income and a gross income, you would be deducting and adding exemptions, and then obviously you could craft their own unique scenario. And what you can use for that is by requesting your client's ITA 34. So at the end of a tax year, when they submitted their taxes, SARS generates an ITA 34 document that you can use to input all this information, and then you start your financial planning from there. So what we'll look at today, and let me just clear all these markings, is I've created a very quick scenario. And I mean, this is no different to a lot of clients you would be working with. So this is a 60-year-old client. They're about to step into the next phase of life, or they've just stepped into that, or they've made some decisions, but not all of their decisions yet. They're married. Only reason why that's relevant is because I add a medical aid in there, so that calculates the deductions, and then this is where the magic happens. A client that's got income from different sources is where this tool is helpful in the financial planning process. Because if Mr. Retired had one source of income, a living annuity, the income that you derive from that living annuity or the life annuity payments you receive, it will automatically take into account the tax tables, and it'll determine your tax payable, and it'll deduct it, and you'll get your net income or your after-tax income. This tool will not be really useful in that scenario. But in a scenario where you are proactively working and planning with your client, and the client's got multiple sources that they can consider drawing from for a sustainable retirement income, this is now where we can be really smart around where we draw from. And it is also potentially a way where by using the tool, you can open up a client's mind to alternative possibilities. Because we've all been in client conversations where I'm happy to draw from my pension, that's the point. But when it comes to my share portfolio, that's one of those sacred cows where it's going to stay there for inheritance. But your living annuity can also be part of the inheritance conversation. But if we don't find a way to demonstrate why it's a good idea and why it's in the client's best interest to consider making regular withdrawals from that share portfolio, or actually taking some money from that unit trust investment, because from a tax perspective, it's obviously more tax-friendly to draw from those sources in conjunction as opposed to just drawing from the living annuity, simply because the living annuity generates pay-as-you-earn tax and income tax, whereas the unit trust or share portfolios generate capital gains tax, which is more friendly from a tax perspective. So let's demonstrate that. So here is the facts of today's case study. So client in the middle, they've got a medical aid, member plus one, they've got a living annuity currently 10 million Rand, and they've selected for some reason to draw 4.8% from this. I use nice round numbers, so it's just easy for us. 40,000 Rand a month, and this is pre-tax. They've got a life annuity, so they're blending the two. So life annuity for certainty, that's at a 7.2% level. Again, ignore the percentage because I just wanted to use a nice round rand amount of 180,000 Rand a year. They do have a unit trust. They have some money in the bank which generates interest. And because they're retired, they're not making any retirement annuity contributions. So again, you'll see how I've tried to implement not just the practicalities of the tax tool, but also the value of advice, because that's the point. That's why clients are paying us fees, is to give them advice and help them along their journey in an accelerated manner to reach their goals more quickly, more efficiently, with greater peace of mind. So if we look at these facts, I'm going to go back to the tax tool and then show you how to simply implement all of these things on the screen. So we'll go to current scenario, it will load it, and then very simply, if we go to gross income, we'll scroll down, and there where it says the 3610 or the 3603, it's all created for you. So all these tabs here at the top that you see, it's already in this. You don't have to go and create them. If you want to add a second salary, it's as simple as clicking on the plus button. So I will call this is my salary from Firecrest, and then here is my salary from my moonlighting gig when I flip burgers at McDonald's, right? And now you're bringing in the facts of the client. Their life is in this document. So it's helpful that you can frame them and you can rename them. So then if we go down to the bottom, here I put in the living annuity income, and it's 480,000 Rand for the year. The life annuity income is there, and we're not using that sacred cow unit trust at the moment. Client said that's long-term, that's inheritance. I was like, fine, let's just show you the impact of, i.e. now drawing more of your income from the living annuity sources or the pension sources. Then from an investment income, we've added the domestic interest generated by the bank account. It's vital. The clients aren't paying tax on that amount. So the interest that they receive, they're getting, right? But it's still going to incur taxes. And again, it's a helpful conversational piece, because you can then work with the client to say, well, is this the best way to utilize that asset? Yes, I get emergency funds. Yes, I get that cash in the bank gives you optionality, but it's generating a tax drag. So how can we keep money for safety and certainty, but is there a way to wrap it differently in order to potentially reduce the tax? So you would put that in under investment income. Clients with company cars, there's space for that. You can do a whole bunch of things, but I think to keep it simple for this scenario, we've just kept it quite vanilla. From an exemption perspective, you'll see there that the interest exemptions is automatically built into the system, so it comes in. If there's any other exemptions that you want to add, you're welcome to do that in the drop down, and all the tax codes are all relevant there, and it impacts the calculation. Then scrolling down, any further deductions you can do. So if you want to model the impact, and we'll get there in the third scenario, is retirement annuity contributions, why it moves the needle in retirement to still contribute to retirement annuities. I'll explain that to you in a moment. And then if taxable capital gain is helpful, I'll work on this scenario. I'll tell you what I did there in a moment. So essentially, this is the first scenario, right? This is the current positioning. And what I love this tool is it actually puts into context what the client pays from a tax perspective based on each rand of earnings, okay? Because practically we know that if your marginal tax rate is 39%, so in this scenario, the client has a gross income of 820,000 Rand a year. So in this current scenario, if you're going back to the facts of the case I've got for you, you can agree with me that 480,000 Rand plus 180,000 Rand from the life annuity, plus 160,000 Rand from the interest earned, that's a gross income of 820. And it's very easy for clients to become really frustrated with their tax payable, because they would just assume because their marginal tax rate is 39% that they're paying 39% in taxes. But that's not true, because of deductions, because of their rebates, primary, secondary, tertiary. So it's not the case. So we want to change the language from marginal tax rates to average tax rates, the rands and cents payable for every cent that you earn from an income perspective. So this is the base case. The client is earning 820,000 Rand a year from different income sources, and their tax payable is 223,000 Rand. That's by simply inputting it into the tool. But what we want to do now with Taxspace, and how I've used it, is to reposition the tax position of a client and then to propose recommended changes in order to better their position. So if we reposition their scenario, and then we would bring in things that they wouldn't normally see as income. So clients making withdrawals from retirement or from unit trusts, they don't normally see that as an income because my pension gives me an income. But from my perspective, any money that comes into your household to live your life on is really helpful, and it needs to be carefully thought out and utilized for your benefit. Otherwise, don't draw from that source if the whole point is you take the money and then you just put it back into investments. That doesn't make a lot of sense, right? Like literally, if you are taking more money from a living annuity, for example, in order to have a bit of excess, to do a retirement annuity contribution, to just put it back into investment pot, long walk for a short drink, it's not going to move the needle. So repositioning somebody's position from a tax perspective and an income perspective is helpful. So and then a retirement annuity contribution, even in retirement, makes sense. Why would you want to contribute to retirement if you're retired? And it's a good question if somebody were to ask that question. So it's literally twofold. It is a tax deductibility consideration, and secondly, it is a estate planning execution. Because if you take money from your income sources, drop it into a retirement annuity, and remember, you can make a retirement annuity contribution, get the tax deduction in this tax year, and nothing prohibits you from, in the same tax year, in the same month, in the same week, from retiring the client from that retirement annuity and looping that funds back into that life or living annuity, because now it moves outside of your estate, and from an inheritance perspective, you can obviously nominate your beneficiaries on the living annuity side of things. So that's a helpful way. So by simply restating someone's income, you can see that the marginal tax rate didn't change, but the average tax rate significantly reduced. And by utilizing a retirement annuity contribution, even in retirement, reduces the tax payable from whatever it was, 223,000 down to 176,000 Rand. So average tax rate comes down from 25 to 15, and tax payable drops from 223,000 to 176,000. So let me show you that in the tool. So simply on this little drop down here at the top, you can then toggle between your different scenarios. If you haven't yet created a second scenario and you're busy building this out for the client within your financial planning process, you would go back to the main menu, go back to the client scenario, so Mr. Retired, and there where you've built the current scenario with all of your information already included, you will simply hit the copy button. Then it duplicates that scenario. You can then rename it, and then you can go into that scenario. So what I've done in preparation for today was to do just that. So what I've done now is in the unit trust withdrawal side of things, right? Because a lot of the times our clients would have more money than they would need. So in order just to keep them in that scarcity mindset, we can unlock their lives by allowing them and empowering them to live their best lives within their means. So in this client scenario, which I think is sometimes rare, the value that we can add to clients is to actually tell them that it's okay to spend a bit more. They will be okay if they enjoy life, and we could demonstrate that through our cash flow models, and we build in the impact of taxes because that's a really vital component. So in this scenario, what I did was the living annuity income stayed the same for now. The life annuity income stayed the same. But then this client said, okay, well, I am making a 20,000 Rand a month withdrawal from my unit trust. It's maybe ad hocly, it's maybe for holidays. And I thought, well, I mean, if you were to regularly take money from your unit trust, it impacts your income, even though it isn't a gross income. because it's capital gains tax in nature, it's important to demonstrate it, because if you add the unit trust income into one of these income sources, it has a positive impact on that net tax rate. Because if it's not included there, you'll see that, okay, now it's going to work the opposite way, because I don't know if I've already added the retirement annuity contribution in there. But if you don't show it in the gross income side of things, then it will not be able to reduce that net rate. Because ultimately, what do I want to show a client? And it's this, and then we'll circle back to this. So in the final scenario, I want to show a client that they moved from a 25% average tax rate down to ultimately a 12.5% tax rate on the right-hand side of the screen here. I also want to show them that we moved from a 223,000 Rand a year tax payable down to a total of 144,000 Rand. So we need to show that and use the tool in order to do that. So, but if you now were to put the unit trust withdrawal into the gross income, please remember to exempt it. Otherwise, it's going to show the client that they are paying more taxes. And how would you do that? Well, you would go down from the gross income tab down to the exemptions tab, and you would exempt the entire income. Because I just wanted to count up to what is the client getting from all their assets. Essentially, what is their disposable income after tax? That's the kind of conversations I want to have. I want to talk about disposable income and your net tax rate, or your net rate payable, your average tax rate, not your marginal tax rate. Domestic interest is the same. And then from a deductions perspective, this is then where you would do your retirement annuity contribution to show the impact on their tax payable. And then from a taxable capital gains perspective, you would then simply add your market value withdrawal from the unit trust's regular withdrawals that you're making. And remember, these amounts are annual because taxes work from on a 12-month basis. And then you would also bring in the base cost. So I just worked on a 25% base cost. It will obviously be unique to each scenario. So you just have to do on your platform of choice where your client's investments are housed, you would run a quick little, essentially a withdrawal simulation, and it'll tell you if you withdraw 240, what is the base cost, and you would use those figures to make sure that the scenario is accurate for the client. So by literally changing anything, as you change something, let's say it's a 50% base cost, so 120,000 Rand base cost. You can see on the right-hand side, every time I type something in, it actually changes the calculation. So this is a wonderful tool to use in your client meetings. Nothing stops you from opening this up while you're sitting with a client, because they might go, well, you know, Rudolph, what if I actually allocate a little bit more money to my retirement annuities? Where do I top out in terms of my deductions? And the tool has got that built in. So let's say you say, well, 350. Look at the top of the tool. It actually limits my amount of deductions. Why? Well, we know the rules from retirement annuity contribution rates, 27.5% of remuneration or taxable income. So you know then, okay, well, we can add more money to your RA if you think it'll move the needle and you want to reduce your taxes further, but there's no point for us to contribute more than 234,000 and a couple of cents. So obviously you can contribute the full 350, we know that, but then it's a disallowed contribution, which has a different impact on your financial planning and on your estate planning. So again, just keep that in mind, but it is something to consider. But the tool automatically calculates your maximum tax deductions, which is wonderful. But let's go back to our scenario. So it's 120,000 Rand contribution to a retirement annuity. And very simply, it then shows the client that your tax moved from, if we toggle back to the previous scenario, which you do in your client meetings, you move from 223,000 Rand tax payable with a net disposable of 600,000 Rand. Remember, we want to reframe the fact that the unit trust withdrawal is also part of their income. So then we would say, well, because we bring it into gross income, but we take it out as an exemption, it now increased the net disposable income for this client. Okay, but now we've made a small change. We've simply gone from the impact of repositioning their income and making a recommendation where a retirement annuity moves the needle. But where I think the tool is at its most powerful is when we start modeling where we draw our income from. And in this scenario, if we look back at the facts, this client has got a living annuity. and they've got unit trusts. So we can toggle reducing the living annuity income payable. And if we reduce the living annuity income payable, it reduces that percentage drawdown. So as you know, 2.5 to 17.5%. If we are able to reposition income, that also means we can reposition portfolios. Because if you have a 6% drawdown, you probably have to be aware of the sequence of returns. So when you start drawing higher percentages from a living annuity, you have to be very careful with portfolio construction, because in years of poor performance or negative market returns, having a high drawdown from your capital has a negative knock-on effect. But if you have a very low drawdown, which in this scenario, I will model the impact of doing that on taxes, and then you can just, in your own financial planning process, figure out what the positive impact will be on portfolio construction, which ultimately speaks positively into compound growth over time, which obviously positively speaks into inheritances within your planning. So the levers here is multiple, and the more income sources a client has, the bigger your amount of levers that you can pull become. So in this scenario, I simply said, okay, what if we take a lower drawdown from the living annuity and a higher drawdown from the unit trust, simply because we have a more favorable tax rate when we take on capital gains tax as opposed to income tax. So this only change I made is I kept the retirement annuity the same. I simply reduce living annuity income and increase withdrawals from the unit trust, and the impact is positive. So, and it's not just positive because we know this, right? Like what I'm saying isn't like, nobody should be surprised by the kind of things I'm talking about. But what is the power of this? The fact that you can demonstrate it. And now you get buy-in from the client and you empower them to make better decisions about their financial lives. So the only change between scenario 1 and scenario 2 is under the gross income tab, I modeled and played around with different income sources. So if we were to take instead of a 4.8% drawdown, which is at 40,000 Rand a month, but we drop it down to 3.6%, which is 360,000 Rand a month, and then we make up the difference from an income perspective by increasing the unit trust withdrawal to 360,000 Rand. Remember then, if you do my model where you want to show the client the disposable income, so looking at 1060, I think was the total amount of income. Let me double check. Yeah, 1060, and you then were to deduct that next tax payable, and then you should get to that 915. I think I checked it yesterday. It should roughly be there. So that's the point you want to demonstrate. You then can demonstrate very clearly that, Mr. Client, even though we're in a marginal tax rate of 39%, you were able to drop that down to a marginal tax rate of 36%. Your actual tax payable on every rand of income, things that come into the household to live your life and live your dreams on, is actually only 12.5%. So as much as we don't like SARS, understandably so, the session is recorded, but hopefully not to any SARS officials in the room, we can show them that your tax position is actually not that bad. So if you add that income under the gross income, please remember to then under your exemptions, exempt that full amount. Hopefully we can build some tools into it over time in our next development phase where we can actually create a separate tag under gross income that would automatically take it into an exemption. So we are working on those kind of things. And then we would keep the deductions the same. Sorry, I'm jumping around there. We will keep the deductions the same because we didn't change the retirement annuity contribution rates. And then we had to then up the taxable capital gain impact. So again, 360,000 Rand into market value, 90,000 Rand in base cost because my scenario was a 25% base cost. And then you can just see the impact of how the tool would then calculate your net tax payable. It shows you your new effective average tax rate and then the disposable income. And that essentially, I think, for today's case study is how I think the income tax tool within Taxspace is really helpful in facilitating better conversations and practically helping clients execute their own income streams in a way that is the most tax efficient. Because now that you know what your tax payable is, if you use a income tax modeling tool like Wealth Explorer if you use Portfolio Metrics as your DFM, or you use Asset Map and use a target map approach for a client, or you use the Wealth Integrator tool from Mutual, whatever whatever cash flow modeling tool you use, this is a helpful component to add in your tax payable so that you can truly demonstrate to a client we're not just working on gross to gross figures, we're working on your actual tax payable, so that you've got peace of mind that tax is not going to sort of catch you down the line. The total income after tax received on a regular basis is yours to spend and enjoy, and you still have sustainability on your financial journey into the future. So, on that note, is there any specific questions we might have? Francois, what is coming to mind for you?
No, I think it's a very practical thing. I guess the question is probably, yeah, but should I do this now for every client that I work with? What is your approach to that? Do you use it for every client? Is it just a standard part of the process? Do you select which clients you do this with? And maybe just share a little bit more about that.
So I definitely use it in the financial planning process. So from that perspective, it's just part of the process. Where I would use it ad hocly or additionally to our process is clients that would, when the provisional tax periods come up, where people go, I'm gutful, I needed to pay in another 50,000 Rand this year, like I'm tired of this, then we use the tool to demonstrate the realities of their tax position. And then, like for salaried employees to look at, because they've got so few levers, to demonstrate the impact of retirement annuity contributions. It's always easy to say you should save for retirement. Retirement annuities do make sense, but there's a lot of other biases that come with it. But actually practically showing this is the impact on your tax position is one of the ways to overcome the hurdle to the hesitance of using your employer's pension or provident fund to make additional contributions or to use your own RA.
I mean, there is lots that Taxspace does, right? We only gave you a glimpse into a specific use case today. So if you want to go try it out for yourself, we do a 10 Rand trial. So it's a 1-week trial that you pay 10 Rand for. And you can go try it out yourself. If you decide this is not for you at this point, or you want to learn more, then obviously you can cancel before the end of the 7 days and we won't charge you. So the cost is 390 Rand per month. Taxspace is not VAT registered at the moment, so we don't charge VAT on top of that. So just know that. So the price is 390. For the Propulsion member, so if you are a Propulsion member or you are a Taxspace client, there is a bit of a discount. Then the tool costs you 351 Rand. So there are specific things. So you can talk to Taxspace if you want to get the code that you sign up with. And then obviously members, you'll find it on the Propulsion platform. You can see what the code is that you can use when you sign up in order to get the discount. So I think that's it from a costing perspective. If you want to find out more, you can go to www.taxspace.app. That's just the website, and then you'll see there's a register and a login button there. Then you can go click on the register button, and you can register yourself an account. It is just about, I think, playing with the tool. Also, you would have seen, as Rudolph was demonstrating what the tool looks like, once you're logged into the system, there is a training button where you can click, where I talk you through every single piece of this. And then just maybe lastly, what we are doing with Taxspace at the moment is to say, well, I want to build the idea is to build a collection of tools where you typically would use Excel spreadsheets to do these little things. We built this all into the app. So it does more than tax, but we always try and bring tax into whatever other tools we're making available. So you will note when you're there are more tools inside of Taxspace as well that you can use. So there is we've got a transfer duty calculator. So often when you're doing estate planning, we really make provision for transfer costs and things that people need to pay. You can easily calculate that. Or a client has a conversation with you around, I want to buy a house. The tool can show you exactly what the bond registration fees are going to be. It'll show you what the attorney fees are going to be, and all of that. Doesn't matter how people do it. So it does that. We're also bringing out now the investment comparison tool where we allow you, and one of them are already live in a beta kind of way. So it's just comparing a fixed deposit basically at the bank versus a guaranteed investment plan from an insurance company. and where you can compare and say which one is really better after tax. So it does that, and there's lots more on that side of the thing that we're almost done with the development that we will make available. And then the next big thing that's coming is the lump sum tax calculations, and also, but I'll share that later on what we're doing with that. But I think that's very cool, and so lots of things. So, and the price is not going up as we add these things, right? So there's a roadmap of what we're going to do, and for that the price is not changing. Only once we're done with all of those things, once we start adding premium things, then, but those things will be, oh, I want that, I need this, or I don't need this. So then you have a choice whether you want it or not, and those things might come at an additional premium. But at the moment, everything we're building is just available.
Does this take into account offshore income? So the starting point when you build these tax scenarios would be somebody's ITA 34. And if there's tax generated from offshore accounts, so from an income perspective, most of us would probably use roll-up funds. But there are spaces within the tax code of South Africa where you would implement your taxable income from your worldwide sources. So if you're doing withdrawals from offshore investments for the purposes of income here, then you can obviously add that either from a capital gains tax perspective or from a income perspective, whether divvies or interest, and then you could just build it into the tool and it'll demonstrate the same.
And also what's nice about the tools, because if you think about the offshore income, right? So you'll put it under your gross income, but then there's an exempt part. So in that case, the system doesn't at this point in time, but it's also something that we could possibly add, won't automatically do the thing, because there's obviously some rules that you need to apply to. So I also can't just immediately apply the exemption if we don't know if the person meets the rules for the exemption, right? So they might be earning foreign income, but maybe it shouldn't be exempt. So we also can't really, like, there's a little bit of judgment that needs to go into that. But under the exemptions, we've got a lot of the exemptions that the system will apply for you. And then there are always like any other exemptions that you can add by yourself as well. So if the 1.25 million is exempt, for example, then you could do that. Or if the full amount is exempt, then you can add of that. So the tool can do that. Yeah.
Yeah, it's flexible enough that you use your judgment as the professional to sit with your client to input the things in all the right places. So I think the other hesitance you would probably have if you're not a tax expert to not use this tool with a client. So maybe not to use the tax tool, but use some of the other tools. But again, we're all, I think, pretty au fait with taxes. We have to be, right, to get our value for money within our income. So if you're unsure of anything, check out the training videos. We will be doing more of these sessions for existing members, but also for new members wanting to explore the tool. So if those things come up and there's a need, we'll definitely create some content around making sure that the tool is as accurate as possible. Because I think the biggest downside would be telling a client, this year you're only going to pay 100,000 Rand in taxes because we planned your income that way, and then there's a whoopsie and it turns into 200,000. That's not a great outcome.
Yeah. So with that, to end us off, Rudolph, I do want to say the nice thing about the tool is you don't need to be a tax fundi, but Correct. The bad thing about the tool is that you can't know nothing about tax. So you need a base level of knowledge in order to understand when something applies and when it doesn't apply. But the tool does most of the heavy lifting for you. So you've got to just understand, because we did build the tool in line with how SARS works. And we've used this tool in numerous occasions where we actually showed SARS that they were wrong and they fixed things for clients when we used to have a tax practice. We use the same tool to show that. So we are very comfortable in the calculations. We know they're correct, but it does depend on how and where you put things in. So that's where the caveat, I think, and the thing comes in. But yeah, so thank you very much. Rudolph, thank you for joining us, for taking your time to share your experience and how you use this. It was fantastic to see it a little bit from that point of view. For me, I'm always on this side of the tool. So for me, a lot of things just make sense, but it's really awesome to see how you use it in practice. So thank you to each and every one of you who joined us today. Thank you so much as well. Thank you for your time. Got any questions, do let us know, and otherwise go check it out, and yeah, we'll be happy to help you along the way. But Rudolph, thank you. Have a good one, and we'll see everybody soon. Thank you so much. Bye-bye.